Hi guys, welcome. We'll be talking about the future of payments, and I've thought that we have a couple of different perspectives here on stage. We'll do a little introduction in a little bit, maybe I'll just say by name, but maybe we can talk today about the infrastructure from the point of view of an infrastructure. So with us, we have Jeff, maybe just 2 sentences about yourself.
Yeah, of course. I'm based in Hong Kong. I split my time in Vietnam and I cover Asia. I have 2 hats in Hong Kong. I lead the industry association called Web3 Harbor, which many of you probably been to our events this week. Do welcome you. We have many, many more events closing out. But besides events, the core activity we do is public advocacy, public-private advocacy with the Hong Kong government when it comes to adoption of Web3 for the Hong Kong market. The other thing I do, my day job, I lead Hashgraph, which is a Hedera company in the region. So Asia Pacific, really focusing on payments. So I'm really excited to be talking about that topic today.
Christian.
Hi, my name is Christian. I'm running global go-to-market in everything digital asset, crypto, blockchain related for Mastercard. I have been with the company for 14 years in different functions, which means I'm not crypto native. So very nice to be here.
Jonathan.
Thanks, David. Hi, everyone. Jonathan Rigg. I'm the VP Commercial at Fuze. We're a UAE-based regulated digital asset infrastructure company operating across trading and payments. So we have cross-border B2B payments, crypto payment gateway, and stablecoin remittances. So yeah, very excited to be talking a bit about the infrastructure side today.
Thanks so much. Nirup, please.
Hey everyone, I'm Nirup. I'm the CEO of BridgePort. BridgePort is a middleware infrastructure company that's involved in building solutions for trading, settlement, and we're across the ecosystem working with exchanges, custodians, banks, wallet providers. Anywhere crypto can be held in custody, we want to be there as a messaging layer. My background is in TradFi. I was in FX and fixed income derivatives for over 15 years, and I'm really looking forward to the discussion and meeting you all after this.
Cool, thanks a lot, guys. So over the last 2 years, at least from my perspective, there was a lot of conversations about change. I'd like to dive in straight away, maybe with you, Christian, because you probably oversee the most globally, or you know some of the information globally. What has actually changed? What do you, where do we start the conversation? What is mostly narrative until now?
Oh, I think what has changed, so I've been in this with Mastercard for 4 years, and I feel back in the days we were always speaking about crypto, now we speak about digital assets.
Yeah.
I feel stablecoins is definitely something that took over in 2025 and dominates the conversation at this point, or at least takes away bigger space, which I think makes it more, the whole topic more accessible to traditional financial services providers. And I contrast this with all the, more the NFT and ICO side of the crypto world that I, at least, from afar, saw being more sort of present or louder, let's say. Or maybe that is also selection bias on our side, because we feel more comfortable on the stablecoin and payment side.
Yeah.
So I feel that is one thing, and then of course the whole regulatory environment shaping up. MiCA in Europe, then Genius and Clarity in the US, and I mean there's various examples around the world. So I would say there's this trend of maturing for the industry, which if you come from a payment first angle, as we would typically do, is very much appreciated on our side.
Okay, I understand. Nirup, maybe your perspective also on that from maybe institutional settlement perspective. Is the capital fundamentally shifting now as well? Is that in the narrative of how do you see that?
Yeah, I think what's undeniable is the activity in stablecoins, right? That's obviously a innovation that's taken hold. But a byproduct of stablecoins, but positive and adverse effects are to do with settlement. So while you can instantly and efficiently send stablecoin across borders, where that issue comes to head is when the recipient of that in the local country has to convert that into local currency to pay a vendor or something like that, right? That hasn't been solved for yet, and that's going to be exacerbated as stablecoins becomes more useful. So I know the question was about asset management, and it all ends up converging to a head, right? So when I worked in FX, I worked in the wholesale market. The wholesale market, if you're not familiar, is where HFTs and banks hedge after they make prices to their customers. So the average ticket size, or rather the minimum trade size, is $1 million, whereas on the brokers, the average trade size is like somewhere between $1,000 and $3,000, right? The reason why it's so high is because that's where price discovery happens. Once price discovery happens, that permeates into the rest of the market, and that's how you get the FX brokers quoting prices, right? So why that's important is when a stable coin goes from, say, US to the Philippines, what happens next? Can that recipient, how do they convert into pesos, right? So there really isn't efficient solutions at the moment. So just like FX, we need wholesale markets for stable coins that can be settled in a deterministic and compliant manner. So what that means is there needs to be price discovery for, let's say, Tether versus whatever the local stablecoin might be. We're not going to see a scenario where there's going to be one stable coin that's going to be adopted globally, mainly because that's going to impact the currency trade imbalance of those local countries, right? So they want their own adoption of various stable coins. So we will see a proliferation of stables, and we've already seen that. I think there's more to come. And as that happens, we need better settlement layers, and that's something that we're working on. We're partnering with several other companies in this region where it'll allow this efficient and deterministic way to settle stables, and that has an impact on asset managers as well when they want to do treasury management or cross-border payments or whatever the case might be.
Nirup, we'll get into the infrastructure in a little bit.
Okay, sorry.
I'll give the word to the other guys. So Jeff, you've been doing thanks a lot, but Jeff, you've been doing a lot on the institutional side.
Yeah.
So are institutions really integrating new settlement rails just from also Hedera, Hashgraph perspective, or is that still operating at margins, or are we moving in the right direction? Let's put it like that.
Well, you know, the companies that we work with in the periphery of the ecosystem, basically the small startups or the localized players in each jurisdiction that are actually helping with the settlement, the merchant relationships, and mainly on the B2B side. Yes, obviously, you have to. Using that technology infrastructure helps with the gross margin of the operating business. I'd like to bring it back and actually connect that question with what has changed, right? I think in the last 2 years, you've seen geopolitical shifts with tariffs and a strong dollar. Let's put aside the Genius Act and clarifications from Clarity Act coming up, and the fact that the euro dollar is actually starting to die off, and economies in Asia who the citizens have had a hard time getting bank accounts, and now the savings that they do have in their local denominated currencies are at risk for debasement, inflation, etc. And that is what is really pulling the demand into this kind of instant settlement infrastructure, because it's the fact that the money is now moving into e-wallets instead of bank accounts.
Yeah.
It's also getting into infrastructure such as telecommunications networks instead of traditional settlement POS systems.
Yeah.
And we see that in markets that I'm very active in, like Vietnam. Year over year, triple-digit increases in contactless payments, in QR code payment, scan-to-pay infrastructures. And that's not a trend. That's just a necessity.
Yeah.
So yes, I'd say on the periphery for the local players that we work with, it's moving that fast. But with the larger, traditional financial institutions and banks, there's a lot of integrations that need to happen. So you see like the neobanks that have maybe a digital payments facility. Those are the ones that are actually adopting new infrastructure.
That's really interesting because the next question would be for Jonathan, because you guys are talking to banks, to institutions, trying to provide also your service and having those conversations. Did they change as for 2 years ago? Is it easier for companies like Fuze to talk to them now, or what is the conversation there?
Yeah, I think we've definitely seen a paradigm shift, and digital assets or crypto has moved from a speculative asset class into one of real-world utility. So Fuze powers digital asset trading for banks, and that was where we began the company 3 years ago. And now the conversation has moved to what other use cases can blockchain technology solve? And cross-border payments, enterprise payments, real-time settlement. We've seen a proliferation of digital asset treasuries as well. And stablecoins are the glue or the sort of the swap mechanism. So if you're using BTC long positions as collateral optimization and looking to do lending or whatever other use cases it might be, stablecoin allow you to operate on chain. And we actually had a meeting last week with a very large global bank. And what was, I think the next iteration is at the moment you have stablecoin sandwich. Like it begins with fiat, it ends with fiat. Yeah. But the bank actually asked us, how do we keep our assets on chain? Mm-hmm. How can we optimize our treasury, operate payments, operate our cross-border amongst our entities, and just keep our value on chain? And then you can look at stablecoin settlement, stablecoin yield. So I think blue sky, but eventually you'll stop seeing the sort of on and off ramp, and it will just become no ramp. So that's the conversations we're having. Those are the questions we're receiving from banks. And yeah, as you said at the start of the question, what became, you're trying to convince people on maybe the use case of Bitcoin or optimize or bringing digital assets into a traditional portfolio. Now it's less about or it's not just about the investment use case, it's about the utility. And that's where the infrastructure and the regulation is starting to power and support the adoption.
So perfect next question that I have on my little pad here. So it's new rails versus the existing infrastructure, right? So I'll give it back to you, Jeff. So on-chain settlement, stable coins, right? Are they complementing the existing, like basically card infrastructure? Are they going to run parallel, or are they going to replace them at some point?
It's running in parallel today.
Yeah.
Right? I don't think we're in a place where a pure replacement will ever happen. There's too much legacy infrastructure in place. And again, the key thing is reporting. Whether you're on the merchant level or if you're in the payment acquiring level, or even on the scheme and the bin level, how do you report all of the different activities as the payment flows are going through the basically the value chain, right? I think we still don't have proper accounting treatments.
Yeah.
Right, so I think things will run in parallel. It's already demonstrating efficiency gains. It's a matter of how those efficiency gains result in nobody losing their lunch, I guess, and then making sure that the commercial models are actually sustainable over time.
So it's basically breaking everything into different layers as well that has to be regulated. How do you see that, Christian? Because I think that's a conversation that you guys are involved in quite a bit, I guess, no?
You mean the new rails versus old rails? I mean, if you look at that original Bitcoin white paper, was this still the birth certificate for the industry? It says, there should be a version of digital money that flows freely without any intermediaries. And I don't think, and everybody can be their own bank and everything. And I don't think in any time soon that is going to work for the population at large, because truth be told, at least in the part where of the world where financial services are available, you have deposit insurance, you have chargeback rights, you have zero liability, you have global interoperability. Whereas in the pure end of Web3 or crypto, there's no one to call. And as always, and we've seen this time and again in different industry, whether it was open source software and all of these things, you meet somewhere in the middle. You have the established players, or some would call them legacy players, and they basically will adopt new technology to basically put on top, what works well, whether it's distribution, structure, compliance, processes, and they adopt new technologies, and then you settle somewhere in the middle, right? And of course, you have certain parts of the industry that will adopt slower. You have certain parts that will adopt quicker, and where there was nothing, basically, there was no financial services, obviously, then, Web3 and all of these things will flourish, just like, if you lived in a world where there was no fixed line, telephony or fixed line data, you wouldn't put cables in the soil, you would go for mobile first, right? And so I think we will see that, and from a Mastercard perspective, we say, for us, it's not about, does the transaction settle over this rail, or this rail? Our mission statement is basically to facilitate safe, simple, secure payments globally. And as a consumer and as a merchant, you shouldn't care, oh, wow, that was an on-chain payment, or that was real-time ACH. Nobody really cares. You want the money there, it should be, with as little friction as possible, and obviously very secure. And all the other things we make happen in the background, basically.
But it's about kind of reducing also, like the shift would cause a lot of risk, right? And it's also the adaptation curve to reduce the systemic risk, right? Like, how do you change from one system to another, right?
I mean, I think every new technology initially presents new challenges, right? Because you need to get your head around. So things like flow of funds, who holds a VASP or CASP license, who has a fiat license, these are questions you don't have to ask if you're operating fully fiat. But on the other hand, when it comes to risk, we operate in a world where, payment feel very real time, but that's just the authorization. I tap my card as a merchant, it says transaction approved or payment made. No payment is made at this point, right? Typically, the money would flow 48 hours later, and that presents a risk, right? There's global settlement risk.
Yeah.
So a world where money can flow freely 24/7, 365 can actually reduce settlement risk. So I think, as any new technology, it comes with a lot of opportunities, and some things you need to be very mindful and watchful, because it also creates new sort of risk vectors, if that makes sense.
BridgePort operates with off-exchange settlement models, right? So I think that would play into that, right? Like, so if the world changes to that would make a couple of things more easier for people. How do you see that?
Yeah, definitely. So I obviously have a different vantage point than the other two panelists here, because I'm not in the consumer space, right? We're very much working in institutional trading. So institutional trading, if anyone's ever opened crypto Twitter in the last 5 years, they always talk about this T+2 settlement, how slow it is, why can't it be instantaneous, and another buzzword is atomic settlement. So as much as we can just sprinkle some blockchain dust and make settlement work, there's actually a reason why you don't want instantaneous settlement in the institutional space. A lot of the times there are error trades, trade breaks, trade disputes that require the ability to reverse a trade or break a trade. And another reason could also be institutional trading runs on credit and net settlement over a trading window, whether that's 24 hours or something shorter, right? So instantaneous settlement is going to be beneficial in some aspects of trading, but not all aspects, right? There are certain illiquid assets that may not go on chain. Then there are liquid currencies, like I think FX currencies could easily go on chain and be settled on chain. But what's stopping that from happening is regulations. And as everyone else pointed out here, it's also legacy infrastructure that needs to be able to adopt. And that's going to take a long time, right? There has to be incentives for a bank to rip up 30-year-old mainframes and adopt blockchain. Like, what is that incentive? And there has to be some financial motivation for it. If they announce that to the street on their next earnings call, is their share price going to pop? Probably not. So what are other benefits that can come through here? And this is going to be, as technology evolves, everyone has to adopt. And I think over time we will. And I'd love to see settlement on chain. Will definitely make it more efficient. And we're actually working with a couple of chains now, a couple of blockchains, to build applications on chain for instantaneous settlement for anyone that wants to adopt. And we're doing that because we think there needs to be a catalyst, and as we show proof of concept, the market will evolve and adopt over time. So yeah, I'm very excited about that.
I think T+2 is for the fat finger problem.
Yeah, exactly.
So I'm hearing a lot of will, let's put it like that, into the future. But you just said you've been talking to a big institution, to a bank. So what is the biggest blocker? Like, we all have a different perspective. My opinion on this is, I think at the moment it's still a really nice narrative, right? But I know corporates, I know institutional players, they're already making money, right? Like, so for them to change and all that whole systemic risk that is involved, like, so what is? I'll put an open question into the round. Whoever wants to go first. What is the biggest blocker? So what is it? Is it frameworks? Is it licensing? Is it technology? Are we talking about liquidity for those systems, compliance, messaging? What is your perspective? Because we have kind of 4 different perspectives here as well, right?
I'm happy to take that initially. I think technology is not the blocker. The technology is there. We've seen the utility is there. I think it's governance and regulation and frameworks to a degree is a big blocker. You know, institutions don't scale into fragmented systems, and we've seen differing levels of adoption and regulatory frameworks. You know, from the UAE or the Middle East perspective, the UAE has been regulating digital assets for several years now, but even within that market, there's multiple regulations. There's, you know, your traditional fiat payment licenses, there's different licensing frameworks for digital assets. Even here in Hong Kong, I think there's several payment licenses, you know, SVF, MSO, the VATP. You know, what license do you need to, in a compliant manner, settle payments? You know, so and then that's where we're seeing the blocker. It's like, what is the government's and then you know, compliance needs to be built in, not an afterthought when it comes to crypto. It needs to be, you know, ensuring that institutions know that they're settling in a compliant manner. So I think licensing and lack of fragmentation and you know, sort of compliance are the main blockers we're seeing at the moment for large institutions coming into the space.
Okay.
I have a probably more simple but pessimistic view. I truly believe the blocker is human behavior.
Okay.
I mean, you think about it. We talk about legacy infrastructure, open banking versus API banking, right? I mean, systems have been in place to generate and extract value from products and services for a while. And if it's not broken, why would you go out of your way to fix it, right? Why, if you're making so many bips on this transaction, why would you introduce something new if it doesn't benefit, solve another problem? In the aggregate total value, it's net beneficial, right?
Yeah.
So I think that's one thing is, though behaviors from the consumer have changed and it's really driving things like instant settlement and digital payments, the incentives within our firms, within the banks, within the financial institutions, those mechanisms haven't changed, right? I think that has to change before you get both sides to really have that massive adoption. You're still as an asset manager, penalized for if you put crypto in a portfolio versus if you buy like Nvidia stock. And yeah, I mean, let's be real. Like, you know, at some point, what's the difference in terms of the risk-on factor? So these are things that need to be changed on the institutional level. And I think I put aside my Hedera hat, from an industry association side, that's a real problem in Hong Kong. And education is a key part of that.
We'll talk about APEC in the next round. I would like to hear the other two perspectives, because also you dealing a lot with consumer behavior, I guess.
I would almost say, and don't get me wrong, because we see a lot of success with crypto cards and the ability to spend, borrow against whatever asset. But to a certain extent, it's almost, and again, it's a privileged perspective in certain part that holds for certain parts of the world, but lack of a problem, right? I always say, if people don't want to pay, right? They want to go to a restaurant, they want to buy something online, but the payment itself, nobody really cares.
Yeah.
And the user experience of having a card sitting on my iPhone, that is sort of the benchmark, right? And that works very well for a lot of consumers. So you need to tell them, why should I now make an on-chain digital asset real-time payment transaction? It's not something they care about. So it also needs to translate into something like, oh, Christian, you know, you want to buy something that's very expensive. You can either take a sort of current account overdraft, or you can collateralize your stock, which, you know, allows us to give you a lower APR. So I think it's about these things, translating all the technology into something that is very relevant for the average consumer. And again, our perspective is very much informed by consumer-to-merchant payments. Of course, there's B2B cross-border payments. That's a totally different conversation, but looking forward to hear what Nirup has to say.
Yeah, look, I'm reminded of when cloud computing came into the fold, right? Like in 2005 or whatever. Every CEO was talking about the benefits of cloud, and all of a sudden they were experts on cloud, right? And it became a strategy to buy points with investors that they're now migrating to the cloud. And why did they do that? Because it was economically beneficial to do so. It was a no-brainer. As opposed to running on-prem or running data centers, you're paying fraction of your cost here and getting the same service, albeit with some compromised security if you really scrutinize on that, right? But that's what motivated that shift. That was a shift in ripping up whatever technology existed for like 10, 15 years at that time. And then as even 10 years ago, if you wanted a cheap laugh amongst the crypto evangelists, you would just mention the term enterprise blockchain, right? If you guys remember back then, there was these private permission chains that was supposed to replace banking infrastructure for trading and settlement, right? And obviously that didn't take hold because that was another hype and a wave that died out with the price crash in 2017 and 2018. And now in the last few years, CEOs are touting the benefits of AI. They don't know what they're going to do, but they want to say AI so desperately, right? And in the same way now, just in the last month, we've seen press releases and public comments from London Stock Exchange, the New York Stock Exchange, Chicago Mercantile Exchange, SGX, Eurex. All these exchanges have come out and said they want to do something in tokenization because that is what is in vogue now. But there is actually a reason for them to start exploring down this path because it's economically beneficial, right? There are going to be benefits, and it's also widely accepted. There's no longer like bank CEOs saying this is fraud and rat poison. We've come to this part of the maturation curve where crypto is accepted, and acceptance is the first part of the 12-step program, I suppose, where it goes to adoption.
We'll get like into the technology and like the tangible value of it, because it interests me as well in a second. I think we should talk a little bit about APAC, right? And I think you are the most present here.
I think I'm one of the experts
but
here.
but we'll start with you. And what I would like to know is just from me not being here. I think the narrative in APAC is that they're ahead in digital payment, right? Like I think that it's just used here much more. So why does this happen here? Is it less legacy infrastructure, more regulative experiment? Because what do you think?
It's a perfect storm, right? It's like when East meets West. I think the biggest narrative from many stablecoin providers when they operate here in APAC is the fact that if you're in Japan, you try to sell a transaction. If you're a U.S. visitor and you buy a Starbucks coffee in Tokyo, time it takes for that transaction to actually close, it's an entire business day. You're gonna miss the cutoff, right?
Yeah.
And so from a trade finance perspective, it was always very interesting, like the time zone issue. So that's one. The other thing too is APAC is different as a major economic center. We have fragmentation of both geographic borders in terms of sovereign countries with their own rules and regulations, as well as currencies. You look at the EU, it's like one massive block. You look at the United States, it's like interstate finance or commerce. You can do it. It's like with US dollar, with euro, etc. But here, like we're switching between yen and won and Hong Kong dollar, Singapore dollar. So it's a perfect storm of like why you need cross-border instant settlement rails that would probably be netted off of stablecoin activities. And then you have the consumer, right? It's a very young population here. And again, because of the legacy infrastructure that we didn't have, or in this region doesn't really have with the traditional telephone lines and other physical infrastructure, having digital payments is quite common. And the last thing is, in Asia, we have this concept of super apps, like whether it's WeChat or Line or Kakao or whatever, depending on which jurisdiction you're in, you have a super app in every country. And because of that integration of a centralized portal, you can move payments around from peer-to-peer, from business to consumer, and back and forth. To the point where you also have wealth management services, payment on top of payment services, intermingling with government services, all within a single app, all within Indonesia, Malaysia, Hong Kong, China, etc. And so that's, again, it's a perfect storm of why APAC has kind of been a catalyst for a lot of these changes. But again, these are very Web 2 digital payment activities. And we haven't really seen that bridge between Web 3 and Web 2 yet here in APAC.
Jonathan, do you think the same? Like, could this be like a settlement hub? Could we establish something here? How do you see that from Fuze perspective? Because I think...
Yeah, I mean, I think geopolitically, you've seen more adoption or more forward-thinking regulation and support from APAC, and then coming from the Middle East, like MENA. I think they see it as almost as a way to disrupt or challenge the more dominant regulation and markets of the US and Europe, and where they see an opportunity to be at the forefront of regulation adoption in the Web3 space. I think that's where more of the regulatory frameworks have come out of APAC and Middle East before the US and Europe. So I think it's almost a challenger statement, but also there's more adoption. I think there's crypto statistics. There's more adoption in APAC and the Middle East than elsewhere. So I think that's where they've had to regulate it faster, and therefore the flows that are coming out. I mean, we see a lot of flow with cross-border flow between the Middle East and Asia. There's a lot of use cases, import-export commodity traders that are using stablecoin rails to move value instantaneously, across time zones. So it's where traditionally maybe SWIFT is not as effective, or there's, we said T+2 a few times, but even FX challenges and settlement times, this is where, in these regions, this is where the use case can be more adopted, because you're actually actively optimizing traditionally bad rails or expensive and bad settlement times.
Cool. I'd like to finish off with something that I gave into the round before, and maybe we start with Nirup this time. But if you have a wish list of everything that you're operating, and you would now remove 50% of all the payment infrastructure that exists, what survives? I'll do an open, like,
If as a wish list, if I can remove 50%.
Yeah, like what would be important for you? Like if considering we look at blockchain as a technology,
I see.
which is more advanced than like everything.
Yeah.
We know that it's more efficient, proficient, it costs less, could potentially be. Like what would you like to see that for your business case and what you're involved with, what stays?
The wish would be to move from these where we are talking about the perceived benefits of the technology. Obviously, we're all involved in crypto, so we can bore everyone to death about how crypto is so great, right? But the moment you go talk to the average person at the bank or something like that, they have to go through this education learning curve, right? So, and so I think they're coming around to that point. So the wish is that they, this year, now that the Clarity Act is going to come out, which hopefully it'll come out about market structure. Market structure is very important in trading. Hopefully that is the catalyst for blockchain adoption in institutional trading and settlement. And I think that once that happens, that will also go through to consumer in different levels. So Clarity Act, let's see it go through this year.
Christian?
I think it wouldn't be necessarily technology that's that I would focus on. I would say we stay very firmly committed to safe, simple, secure payment and optionality, right, and choice. And whatever technology ticks the boxes, we're happy to deploy this, whether it's cards, open banking, real-time ACH, blockchain, and then again, all the fintechs out in the world, they can build the best value propositions and put it out, and then consumers will, decide with their feet or their thumbs, basically, what kind of applications they use and download.
I think, yeah, like...
Nobody said Swift yet, but...
I just think, there's a lot of talk about sort of replacing traditional payment systems. I think actually what we're seeing is less replacement, more optimization. It's layers built, it's another technology layer that will be built upon existing systems, and then we'll see an element of consolidation and harmonization over time. So I think, yeah, the narrative of everything's going to change, it's going to replace legacy systems needs to be better termed as it's more of a optimization and harmonization over time that we'll see.
So you think very slowly, no, like full replacement is just going to like web in and grow out into something new?
I think like in life, most change takes time. It's never going to be instantaneous. So, and as I said, we've still got fragmentation. There's a lack of interoperability between blockchain-based payment systems and traditional payment systems, regulatory frameworks across borders. There needs to be harmonization across that before true adoption can arrive.
I have to be very careful how I say this because it's probably being recorded. But the removal of redundant KYC processes. Yeah. KYC, KYB, AML processes. And I'm not saying getting rid of KYC, AML, right? What I'm saying is the fact that there are many legacy processes that require you to submit multiple times, multiple different copies, and it's not even stored in a very secure way. So replacing that with a proper composable digital identity that is interchangeable, interoperable, and accepted via various standards across jurisdictions, across firms and companies, to really be that agent that removes friction. Because I think most of that friction actually comes from that. Besides, you're talking about settlement times, et cetera, between time zones. So that's what I would wish for, is the promise of having more frictionless economic activity without having to do the same thing over and over and over and over again when it comes to KYC AML.
Cool. So it was a very interesting conversation. Thanks so much, guys. From my perspective, just hearing everybody, it just confirms what is out there and what everybody knows from all the developments and updates. I would like to see that the different parts of the institutions work together, because I think the best thing to do with new technology is have this Formula One effect. Yeah, that it is developed under hard R&D with institutions together, and then went down to all the different rails and all the different payment solutions. Doesn't matter if it's institution, if it's new protocols that are developing that, if it's companies working with institutions and different players, or also the retail side of things. I think that it has to be developed and then go down all the way to the consumer, because in the end, everybody will profit from this. We know that for a fact. Thanks so much, guys.